if only I knew about that option before I started a policy. You ever feel like that with whole life insurance? You ever feel like that with any product or service? I know I have. This often happens when it comes to whole life insurance policies, specifically with individuals that are interested in maximum cash value. Now, what I mean when I say that is, to be very, very direct here, is people will often open a whole life insurance policy. Your goal is cash value. You're told that the policy you're opening is the best ever. It is maximized for cash value. You open the policy and then you find out after the fact it could have been better. Often with the same company and product, it could have just been designed for a lower commission to the agent and higher cash value to you. Or maybe it is a different company and product. But the big thing is, if only you were aware that different options existed, then you could have picked the option that you are most comfortable with, not the person recommending you the policy. Now, I state it or phrase it in that manner because this happens a lot when it comes to whole life insurance for a variety of reasons. And that's not to say all agents are bad. That's not my intent in any way, shape, or form. But it does happen, and a lot of people get frustrated with whole life insurance. So what we're going to go through really in this entire series is different whole life insurance products, different ways to design them to provide awareness to you, the individual interested in a policy, on how to maximize the cash value, what to look for when it comes to the design, the company, the product, all of that good stuff, so you can make the best possible decision, whether you decide to work with us or anyone. Let's get into it. So, when it comes to whole life insurance, there are a lot of different products that are available. There's a ton. We are going to focus on really the four main categories. This does not cover everything, but it will cover the main categories through this entire series, not all in this video. The first is the traditional policy, so a traditional old school whole life insurance product. Then we're going to look at a high early cash value product. Then a hybrid product, which is kind of in between the two. The name hybrid whole life, or if you Google search hybrid whole life, doesn't really exist. I made the term up just because of how the product works. It falls in between those two. And then we've got limited pay policies. Now, all products with different companies have pros and cons. Again, the key is for the consumer to be aware. Or if you're an agent trying to become more aware to do a proper service or provide the proper level of service to your clients, this will be helpful as well. We do have an agent training program. Feel free to reach out to us, or you'll see it available on our website as well. So I'm going to provide just an overview on each of the categories in this video, and then we'll be laser focused on each category in the following videos. So when it comes to policy design, something we talk about quite a bit, if we were to start with a traditional life insurance policy, here's exactly how it works. If you were to pay any amount of money into a life insurance policy, you can actually choose where your money goes. It can be directed toward the premium piece or toward PUA riders. And a term insurance rider is added as well, but here's the two main areas. Dollars you add toward the premium piece, this is referred to as the base premium, with respect to your cash value. So specifically here, I'm referring to a traditional whole life insurance policy. Here's how it works. You'll often see 0 of those premium dollars show up in cash value in the first and second year. The reason why is that the insurance company is going to overcharge me for the death benefit up front. Now, as time passes, as you continue to make premium payments, you will find that the premium dollars show up in cash value beginning years 3 onward. However, first and second year, nothing in cash value. Whereas the PUA rider, which stands for Paid Up Additions Rider, I like to refer to this as a cash dump-in. Money I add here, oh yeah, shows up in cash value right off the bat. That is money you can access, begins to earn the guaranteed rate, begins to earn dividends. This is the key to accelerating the cash value growth in a policy. This is particularly true when you look at the guaranteed values and actual performance. This is something that is not used that much in the industry, the term actual performance. I wish that it was. We're making our efforts to make it more well-known. We're putting forth efforts, I should say, is a big, big problem in the life insurance industry, specifically with cash value life insurance, is we have illustrations which project certain values, and often they don't come true. We then have actual performance. So getting the actual results is important, and what we have found to be so consistent is the higher this allocation is, the more money we pay toward the PUA rider, the greater the performance is on one's policy. Now, that will buy us some death benefit as well. But the PUA rider, what's interesting about this, will function almost identical in any type of product, with some rare exceptions when you get to limited pay policies. But for the most part, this is going to function the same regardless of the product type. The main thing here is that this traditional policy, main takeaway, if I'm you trying to learn, hey, what product should I choose? Whatever your base premium is, if it's $1,000 per year, do not expect to see any of that $1,000 or a small percentage show up in cash value in the first year. First and second year, I should say. If it is $10K per year, don't expect to see any of it show up in cash value in the first year. Now, to hit on an important point, you might say, well, can I put 0 in the premium and everything into PUAs? My answer is, I wish, but we cannot go quite that low. The lowest we can typically go with cream of the crop companies, your 4 major mutuals, is often 10%. Some smaller companies will let you go lower than that, to be completely transparent. However, when you look at the quality companies, often they don't. 10% is often as low as they go. So if you said, hey, I want to be able to pay in up to 10 grand per year, I would need a minimum premium of at least $1,000. That's the case with traditional policies. High early cash value policies. How these guys function differently. Kind of in the name, high early cash value. Any amount of money I pay toward the premium piece, so again, money can go toward one of 2 areas. I'm going to direct it, right, toward premium and PUA. The premium dollars, you will find that approximately, it's going to depend on the company and product, between 90 and 95% of the premium piece. This excludes PUA payments, but 90 to 95% of the premium shows up in cash value right off the bat. That's in year 1. So they do not overcharge me for the cost of insurance or the base premium in the first and second year, which is nice, especially for business owners or individuals who like to see that cash value up front. With that said, there's always give and take. The drawback to these products is when I look at them over the long haul, they do tend to underperform compared to other policies, because what the insurance company is doing is not overcharging me for the cost of insurance up front. When you actually break the policy down, specifically these high early cash value products, the costs internally are higher, but they spread them out over the life of the policy, giving the consumer more upfront. Some people don't mind that. Some look at it and say, hey, this is still a great area. I can store money, and then I don't take this huge hit in the balance sheet right off the bat. I've got access to more capital. That's a great opportunity cost. So it all depends on the individual, of course, but it is a good option to be aware of. Often people are not even shown that. So good to see that. Let's continue on here. Hybrid policy. So how this guy works. This is one of my favorites actually. And we'll touch on it in the hybrid video. But how this guy works is whatever your premium is does not show up in cash value only in the first year. Do you remember what the traditional was? Nothing showed up in years 1 and 2. How about the high early cash value? You get most of it in the first year. So with a hybrid product, you don't get any cash value from the premium piece only in the first year. Beginning the second year, it comes back to work for you. Begins to compound, gets better and better and better. PUA dollars, whether it's traditional, high early cash value, hybrid that we're on right now, function identical, plowed into PUAs. I see it in cash value. Oh yeah, that's how I accelerate it. So that is the hybrid policy. I'll see richer cash values up front because the premium piece starts to come back to work for me earlier. Now, often the hybrid will underperform long-term compared to the traditional, not in all circumstances. If I want to pay into it for a very long period of time, that's the case. However, where these work beautifully, in my opinion, I do this with some of my policies, is if I say, hey, I want to max fund this policy for 5 years, for 10 years, and then stop, or maybe I just pay the base premium or a lower amount, that's where I can reap the upfront benefit of the stronger early cash values with this product and reap the long-term benefits as well when you actually measure the internal rate of return and the long-term performance. Then we look at the limited pay products. So limited pay, what this means is how long you can pay into the policy. For example, what is very popular among many insurance carriers is a 10-pay policy. It's pretty straightforward. What 10-pay means is that I, from the policyholder, can pay into it for a maximum of 10 years. After that, I can't pay anything into it even if I want to. Some companies allow you to add PUAs when no premium is due. One it does actually, that's Guardian with their 10-pay product. But aside from that, like once I've funded it for 10 years, nothing else can go in. Like that's it. So how these policies work, PUAs are the same for the most part. When we get to that video, we'll go through some differences there. But how they work is with respect, again, to the base premium dollars, because this is where we're going to see a difference with everything, is as follows. Premium dollars with respect to your cash value. In the first year, you typically get about 30 to 35% of your premium payment. So what that means is if I'm paying 10 grand into the base premium, I'll see anywhere between $3,000 and $3,500 in cash value in the first year. Beginning the second year, I see just about all of it come back, and then more and more each year thereafter. So those limited pay products are nice for upfront cash values, and often what you'll see, if you do things right with these, you will get very strong long-term performance. Sometimes the strongest internal rates of return. Sometimes you'll see you can get the same with the hybrid product, and that leaves the option open to fund for a longer period of time. But in many cases, you can really juice a policy. This is great for someone that is very, very intentional, stating, I don't want to pay into this thing for any longer than 5 years or 10 years. Maybe it's 15 years, however long it might be. And again, they're not always the way to go. I will say we sometimes use these. A lot of people like them, but then often that hybrid option, we look at both and you'll see the performance, guaranteed and non-guaranteed, is so stinking close. And then the hybrid policy gives you the option to keep on feeding the policy if you want to. And again, I'm adding a lot of pieces in here. The reason why, awareness. If I am aware of what is available, I can make an educated decision. So this was a lot here. We're going to go through each piece, option one at a time. I do hope this one was helpful just from a pure informational standpoint. See you in the next video. If you enjoyed this one, please do hit that like button, subscribe for more, and as always, I hope this helps. Talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.